Welcome to Illuminati Silver. We tell you the truth about silver. Today is Thursday, the 12th of December 2019, Election Day in the United Kingdom. And it's just 10 a.m. here, and we're commenting on what we predicted some time ago, the Fed's decision not to raise interest rates, and what this means for gold and silver prices. So let's investigate. Well, yesterday was both uneventful and eventful. Let us explain. In the morning, we put out a video podcast entitled Fed Interest Rate Announcement Today, where we made it very clear that there was no way that the Fed would reduce rates, and that depending upon what Jerome Powell said in both his statement and at the press conference afterwards, would give us guidance on the Fed's thoughts going forward, the potential of any further rate cuts in the future, and effectively its effect on the US dollar, feeding through, ultimately, to gold and silver prices. Now, we've stated for many weeks that rates would not be reduced in December, and one of the many benefits our subscribers get from following this channel is that we do not simply repeat what the pumpers say, or find a guru and repeat what he or she says, but actually undertake our own analysis, utilizing our contacts, and relying on our experience in predicting or forecasting what is likely to happen. Now, thinking about it, and without meaning to boast in any way, shape or form, but we have actually been right about every interest rate decision this year, last year, and the year before, even when the likes of Schiff and other so-called experts said rates cannot go up, when we stated they could and would, and they did, and when others stated more recently that they will now continue to go down, and we have said not so in December, and quite possibly not until well into 2020, if at all. Now, we can make these forecasts not because we have a crystal ball, but we are well connected. We understand these markets because of our past vocation and experiences, and we follow very closely the speeches, articles, and answers to questions, including congressional testimonies, by those who decide these things. We also have a clear idea of what senior bankers and governors are thinking, often from the conversations, believe it or not, that they have with British bankers in closed meetings, some of which we do attend, not many but some, and others our colleagues who attend advise us of. Now, that doesn't mean we know every single decision on every occasion, but it does set us apart from those who are just guessing, making it up, and regurgitating the pumpers' diatribes or philosophies, or just sharing their own wishful thinking. Now, let's actually go over the salient points of yesterday, as they are critical moving forward. Firstly, the Fed, or more accurately, the FOMC of the Fed, voted unanimously, yes, unanimously, to keep rates on hold, leaving the Fed funds rate at 1.5% to 1.75%. We'll talk more on this in a moment. 2. The dot plot of individual members' future projections indicate no further rise in rates for 2020. Now, a dot plot, by the way, is a statistical chart that consists of data points plotted as dots on a graph with X and Y axes, which the Fed uses to convey its Fed funds interest rate outlook, for example. 3. The Fed's current stance on monetary policy, according to them, is sufficient and appropriate to support sustained expansion of economic activity, a strong labour market, and inflation close to the symmetric 2% objective. Now, Fed Chair Jerome Powell made it clear that unlike previously, all members of the FOMC were in agreement not to reduce rates in December, but that they were also happy and decided not to increase them in 2020 or necessarily reduce them. And they were broadly happy with current policy moving forward well into 2020 and then 2021. But of course, this decision not to change rates is subject to market data and movements. You see, the dot plot published, which is a useful tool for also showing any outlier potentialities, while simplistic, does show us that all things being equal, the Fed is neither expecting to raise rates next year nor lower them, but to keep them more or less where they are. That is at least their intention, and we actually believe that is their intention. Now, they may use other methods to ensure sufficient liquidity in the marketplace, and this is where the advocates of QE come in. But we suspect they will use rates rather than full-blown QE if they have to. But there might be a few moves in the background that will enable them to ensure sufficient liquidity in the marketplace without increasing their own balance sheet too aggressively or as aggressively as they did after the last financial crisis. But what is interesting, and this is a telltale sign of a pumper or a secret pumper pretending not to be one, they will say they aren't going to raise rates next year, so that is code for they will lower them, and gold and silver prices will rise substantially because of it. Going back to the FOMC, just keep that in mind. Going back to the FOMC, it's also predicted that GDP for 2019 will finish at 2.2%, followed in successive years by 2%, 1.9% and 1.8% gains, thereby admittedly showing a slowdown in the rate of GDP growth over future years, and lower than the 3% that President Trump has called for. But we also have to bear in mind that the Fed is actually publishing quite a positive outlook for 2020, even at just 2.2% gains, because unemployment, or should I say employment, is at 50-year highs. They also, however, reduced their inflation expectations for this year as well, with personal consumption expenditures falling from an original estimate of 1.8% to end the year at 1.6%, with a target range of 1.9% in 2020 and 2% in 2021 and 2022. So all of those pumpers, or secret ones not pretending not to be, we say that because we have found a few YouTube channels where they pretend not to be pumpers, and they are. We might out these in the not too distant future. They will tell you that hyperinflation is on the way anytime soon. Well, we know the Fed is really 100% right. But it's also really way out either. It's not often that they get it totally wrong, certainly not in recent years. Perhaps the decision to raise rates last December might have been one error, but they very rapidly corrected that. But on inflation, they've probably been more optimistic. In other words, they've predicted a higher inflation level, certainly over the last 9 years, than what's actually occurred. So, with them predicting now 2%, we see no reason why hyperinflation should, at least for the next couple of years, even be a consideration, let alone a worry. Now, some people are commenting about the repo market and the amount of liquidity the Fed is pumping into that marketplace. Well, they'll be pleased to learn that the Fed has attached to its statement today that the repo rate is currently trading at 1.45%, some 10 basis points lower than in October. Now, we admit that there will continue to be bank monies being fed into this marketplace, and we will cover this again in a future video because there have been quite a few misconceptions as to how this system works, and quite frankly, how one should be concerned about the increasing level of, we'll call it subsidy, but not necessarily regard it as a fateful event. Now, at the press conference following the bank's decision not to raise rates or reduce them, Fed Chair Jerome Powell stated, quote, "Our economic outlook remains a favourable one, despite global developments and ongoing risks. As the year progressed, we adjusted the stance of monetary policy to cushion the economy and provide some insurance. This shift has helped support the economy and has kept the outlook on track," end quote. Now on jobs, he added, quote, "I think we've learned that unemployment can remain at quite low levels for an extended period of time without unwarranted upward pressure on inflation," end quote. Now what is most noticeable is that not only did all of the voting FOMC members agree not to reduce rates in December, but none of them, even the most dovish in the past, none of them foresee the need for reducing them any further in 2020. And that is unparalleled, because there have always been hawks and doves on the FOMC. And this time, all of them seem to be in sync and in line with one another. Now, if they're proven wrong, it will be the tragedy of the decade. Now, you may or may not remember, but when the Fed lowered rates last time, which was in October, and that was the third rate for the year, we stated then that historically speaking, when the Fed has lowered rates more than 3 times in a row, it has meant imminent recession. But when they have lowered them up to 3 times, and the next step is then upwards, the recession has been avoided. This historical precedent is known to each of these members, and also those financial journalists, market traders, investment advisors who watch them closely, and they know that a further cut, even if it was really warranted, would send entirely the wrong message to the markets. So rather than it being positive because rates have gone down, it would have told the markets a recession is now imminent. Now yesterday, the Dow Jones closed up 29 points, some 90 points short of 28,000. And the S&P 500 was up 0.3% and the Nasdaq up 0.4%. Now the dollar had fallen back a little yesterday to 97.12, while gold fell back from its day high to 1474, but was still up 0.7% on the day. And silver fell back slightly post the announcement to 1687, but was still up over 1% for the day. So they had risen in expectations. The announcement came out, there was a slight blip up, and then they fell slightly. So let's take a look at how all of these figures are performing this morning. This morning, gold is trading at $1,473 an ounce and silver at $16.85. Marginally weaker from last night, but with no real discernible change to speak of. European stock markets are broadly up, with the UK FTSE 100 index leading the way, up just over 0.5%. And Asian Pacific markets showing a mixed bag of results overnight, with the Hang Seng index strongly up by 1.3%, while the S&P ASK 200 index is down by 0.6%. The dollar index is currently 97.15, little change from last night, and of course markets are also awaiting the European Central Bank's interest rate announcement out later this morning, which will also potentially have an impact on the US dollar and the price of gold and silver, though we again are not expecting major moves in either direction at this stage. We do not see the Fed's comments having a major impact on gold and silver, with the following exceptions. One, whilst the comments were not hawkish, they did give the impression that there is no reason to lower rates next year, as the US economy is moving along quite nicely, and especially when compared with other global economies. Two, traditionally the US dollar weakens towards the end of the year, and there was nothing announced yesterday to prevent that or to cause that. So precious metals may get a slight bounce if history repeats itself. 3. It's too early to tell, but if equity markets like this decision, and remember they were calling for ever-reducing rates, but they may be comfortable in the knowledge that the economy is quite strong, then there will be little migration from equities to safe haven assets such as gold and silver. 4. China, and Brexit are likely to be the two major determinants of where gold and silver prices are heading. Now, we shall know the UK election result by tomorrow, and what is going to happen to the extended tariffs on China by Sunday, though we suspect there will be an announcement either on Friday morning or just after markets close. If tariffs are increased, then this will hit equities, and the gold and silver prices will rise. If they are delayed, or a new trade agreement is announced, in other words phase 1, then the opposite will occur, and there will be downward pressure on gold and silver. And 5, there are some geopolitical issues lurking in the background, which still could upset global stability. And of course we're talking about Iran, the Middle East in general, North Korea and Hong Kong. Now again, if they abate, it will be negative for gold and silver. And if they increase or escalate in negative activity, then that will prove positive for gold and silver. Our initial reaction to all of this is a slight weakening of the dollar and gold and silver holding firm. But we see no reason for a major rise, save the caveats just mentioned. Our assessment, to be frank, is all things being equal, the US economy, when compared with Europe and the United Kingdom and a number of other major trading nations, is actually doing quite well, relatively speaking at least. And therefore we suspect the US dollar will hold up moderately well, and short term, gold and silver will still face a number of headwinds, and unfortunately for all of us, silver in particular. Now, we shall provide a much more comprehensive update on Saturday, when we are likely to know the China decision, which we believe will have the greatest short-term impact of all. Thank you so much for listening. Please share your thoughts, and if you haven't already done so, please subscribe to our channel and press the bell sign so that you're notified of videos as and when they are published. We hope you have found this video interesting and informative, and if so, please give it a thumbs up and share it on social media. Please ensure that you have subscribed to our channel and press the bell sign so that you are notified of any future videos. Also, kindly visit our website at illuminatisilver.com, and if you haven't already done so, please subscribe either as a free or paying member for regular email updates and offers. Disclaimer: Illuminati Silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners.